Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Also remember, this is all relative. One of the mistakes people made about the dollar during the credit crunch was the fact that, yeah, no doubt, the U.S. was in terrible shape. We continue to have a pretty nasty economy, and it may be getting worse. Who knows here? But ugly, ugly, ugly. And each day we wake up, we're treated to new bad news in the U.S. economy, whether it's too much spending, whether it's rising unemployment. On and on. There's a laundry list. But you always have to keep this currency game in mind. It's always relative. You have to have some basic understanding of the fundamentals in the other countries, the major countries in which the dollar competes against. It's always a relative game. So it may be very ugly here in the U.S., but if it's uglier than in Europe than it is here, guess what? The dollar wins. And one of the problems, as I said, with the credit crunch was there basically was ugliness everywhere as it started to break, but it looked like everything was centered in the U.S., the cause of the credit crunch. That's debatable, but we don't have time to go into all that. But the point was that, hey, the U.S. economic numbers are looking bad. They drove the credit crunch. Therefore, the dollar is going to get killed. That was the prescription. Of course, the dollar soared and fooled these people because they didn't realize, number one, it's a relative game, and number two, it's capital flow is what drives currency prices, regardless of what we see on the top side in terms of the economic analysis. And in the credit crunch side, the capital flow piece of the equation of fundamentals really confused them. People had to run and hide into the U.S. Treasury markets because things were so bad globally. The U.S., from a world reserve currency standpoint, has the deepest financial market. So it didn't matter that the U.S. economy was falling apart too. People had to hide in the U.S. in the capital markets, and that was a powerful, powerful driver for the dollar. We happened to get it right at that point, and we did very, very well when the U.S. dollar started moving in July last year. We got chopped up pretty badly from March to July expecting the move, but we were positioned for the move and made up for anything we lost. And that was a great example of understanding how capital flow trumps the fundamentals that we see on the top side, and not understanding the basics of people having to move money for different reasons on the bottom side, so to speak, the part of the economy we don't see. Also remember, you're not looking at the fundamentals here to try and forecast the future. We cannot forecast the future, no matter how good we think we are, no matter how good we think our crystal ball is, whether technical or fundamental. But you don't need to be able to forecast the future. You need to understand solidly what the consensus is thinking about the fundamentals. You have to watch how the reality plays out against that consensus view, which gives you a piece of information. And if you develop that plausible alternative scenario that may happen to play out in the future, not again that you're trying to forecast, but you're developing plausible alternative scenarios based on the fundamentals, a fundamental read that's slightly different from the market, that's how you make money using fundamental analysis alone. But keep in mind, this is not about trying to forecast the future, and you don't need to make money in the currency markets or any market. If you get into trying to forecast the future or thinking you can forecast the future, that often gets you into the most trouble, so definitely keep that in mind. Made the point that we from a standpoint of the fundamentals, I guess as we step back, really we start out with a top-down global macro approach, and that's really stepping back and trying to look at the world in terms of, again, money flow and seeing what's hot. what region are hot? What asset classes are hot? Where is the money flowing? Is money flowing to Asia? Is that the capital, long-term capital investment opportunity? Is money flowing, into Europe for consumer opportunities? Are U.S. assets cheap? Is money flowing back on a foreign direct investment basis back into the U.S.? Is that the capital driver? When you step back from a long-term and look from a top-down global macro view, that's your first objective, because if you think about these things, as you do your fundamental analysis, you move down, down, down. You have this broad global view, because you've heard people say that if you allocate your assets properly, you're going to make money. Meaning, if you get in the right ballpark, you increase your chances of making money. Fundamental analysis tends to put you in that right ballpark. If you get it right on an intermediate term basis, it increases your chances of making money. Perfect example, this year, we went through the credit crunch, then we had a big risk bid, and the dollar moved up sharply, and I'll show you the charts on this in a bit, and then the dollar started back down. Money started to flow again back into Asia, back into the emerging market. The BRICS were hot because China was stimulus perceivably, and in reality it did work at a certain level, and markets moved in a big way. So had you started to get that right and saw that trend going on of money moving offshore again in a big way, and you threw a dart at the types of currencies that do well in that environment, the commodity currency is number one, you would have gotten that right and done pretty darn well. We missed some of it in the beginning. We were a little too focused on our view. We got some in the middle, and we've missed some at the end here on this move, whether or not it's the end or not, but we think we're getting close to the end of that move, but I'll get to that in a minute. But again, if you were in that ballpark and you had that top-down global macro view, you could see that money flow again back in Asia. You started to see the Asian stock markets rebound. You started to see the credit spreads decline in some of the riskier emerging market classes of credit. Those types of things started happening. If you paid some oil prices started to move up from the bottom, started to bottom, consolidate. Again, we never know where the bottom is, but they started to consolidate, test the bottom, and move up along with the emerging markets in price, looking at those types of asset classes. So again, just by your reading, just by your simple analysis, this isn't going into detail, and I'll get to what we do. You got that part right. You got in that ballpark. You made money in those currencies. I have a comment here, and I actually have this website listed for you where this article is written, That Which Is Seen and That Which Is Not Seen, from a French economist back in 1850, Bastiat, and he really was great in that he makes the point that we make decisions, unfortunately, on that part of the economy that we can see, that headline news stuff, or that first reaction we see, that big bang type of thing, but we tend not to think about the secondary reactions that are going on underneath the surface. Credit crunch was an example. The big bang, the big blowout in the commodities market, big blowout in the subprime real estate market. It's huge all of a sudden, therefore the U.S. is going to get killed. Didn't understand the secondary add-on factors of, hey, this has implications far beyond the U.S., and it's going to change the pattern of capital flow underneath the surface was an example. So if you like economics or want to get an understanding of this idea of that which we see in the economy and that which we don't see, Bastiat was great with that, because the reality is the stuff that we don't see is as important, sometimes more important than the stuff we do. So always keep that in mind when you're doing your fundamental analysis. There's only going to be so much that you do see. I think I already made the point that pure money flow ultimately is going to trump your fundamental analysis. If there's stuff going on under the surface that we may not necessarily see, but we can, if we think in scenarios, we can sometimes get ahead of that. But the reality is the stuff going on in terms of money flow trumps whatever people think about the economy. And again, we get back to the relativeness of what's going on in the world when it comes to currencies. And I think stepping back from a global macro standpoint, again, what's hot, what's not, starts to allow you to start to develop these scenarios. And I'll explain that in terms of our scenario, in detail in terms of what our scenario is in the last couple slides.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.